One of the most prominent and knowledgeable insiders in markets has just sold once again. Last time he did this was at the peak. So what does that mean for us as traders and investors? Well, in today's video, we take a look at the key levels that you need to be watching over the next coming weeks and months, and why during Trump 2.0, we need to be more focused on the bonds market than actually stocks themselves. Could we now have found the pain point where the plunge protection team has to come in? And have we seen enough signs to say that maybe the bottom is actually happening? Today, we cover stocks, commodities, and cryptos to break down everything that you need to know about markets right now. Guys, this is going to be a great one. We'll see you in a minute. Well, welcome back everybody to The Daily Show. My name's Tom, and in today's video, we need to talk about insider trading and obviously the macro, the data, the big dark pool activity, and more importantly than any of this, maybe the key levels. If it's your first time here, then remember to subscribe and smash that bell icon. But let's kick things off straight away with, of course, JP Morgan's Jamie Dimon, because it looks like he's placing some large trades in the markets once again. Now, I thought this was a great chart here that we posted over on X, courtesy of Unusual Whales. And what you'll notice is that not only did Jamie Dimon hit the absolute peak, but he has also hit what looks to be the recovery. Now, there are some arguments to be said that this is the exact same type of sell that he did in 2024, but they are big trades and they are happening at pretty key levels, you would have to think indeed. Will this go into our knowledge bank, of course, for what's going to happen next? Yes, because remember, it's not just Jamie Dimon that's been selling here at the highs. We've also seen Warren Buffett reducing to around 26 to 27% cash holding. And of course, we've seen other high-profile sells in Tesla and other stocks around the world. Now, what could this mean? Could it be a peak? Is it an incoming recession or something worse? Well, I think it's best we take this by a day-to-day structure. And as you'll find out soon, we will be talking a lot about structure this week as we look at how the market has been recovering and, more importantly, whether we did too much damage with these recent tariffs in terms of market structure on a recession path after the Federal Reserve does cuts. Now, the focus has been on bonds markets, and we're going to look at that in just a moment, but let's talk about CTA positioning. For the bulls, as we always like to look at both sides, bulls will like the CTA positioning. It looks like more purchasing is having to come in, and according to the latest Goldman Sachs report here, you'll notice that we are right at that kind of massive oversold signal. So in all cases, according to Goldman Sachs, we are seeing either upward buying of $23 billion, $11 billion on a flat tape, and even on a down tape, an overall positive. In all cases, basically, the CTAs are going to have to start buying into this market once again. Now, why could that be? Well, it's just the general thing that happens around this time of year. But on top of that, we do still have earnings results coming through. And on top of all of this, we are following the narratives. That is, if you look at the previous cycles, the 1990s cycle, the 1960s cycle, or of course, we look at where we are right now, or even the 2018 cycle, often April, end of March was the bottom of that particular drop. Now, what ended up happening in a lot of these cases was the market actually made it to an all-time high. And this is why we're focused on this next month and a half of structure more than anything else in markets. If we fail to make a new high and fail to break some of the key levels we'll look at in this video, then we could be leading into a recessionary path. And many of you do believe we are on that path already, and potentially rightfully so. If we actually overlay here the 1996 to 98 period, and then of course what happens after that, you'll notice that they are quite similar. And you could also make a lot of parallel, like kind of shifts with this as well, to say this was the beginning of the WWWs, that is, of course, the internet. And then we also have nowadays ChatGPT overlaid on top. That's what we were looking at just before. So we've got the internet versus AI. Do we tend to have sells at around these periods? The answer is quite simply yes. Is it more than a coincidence? Potentially. And of course, the upcoming tax cuts, deregulation, Fed put potentially, or even tariff getting more exemptions or being reduced could all be bullish catalysts, as we do expect at least earnings to look very good based on what we're seeing so far, with the forward guidance being the major issue. Remember, markets hate uncertainty, and at the moment we are climbing the wall of worry as markets try to figure out whether we're going to be in a much better position over the next few months due to some of those things we've outlined. The other thing that's worthwhile keeping in mind is that when you see an extreme VIX event, that is an extreme volatility event, guys, like we saw over the last week and a half, then you tend to follow these types of paths. Most of the time, they stabilize around this area. So while a lower low is not out of the question, 4,700 particularly being a very, very key zone to mark out on your S&P, as we'll see soon, then generally speaking, the market will structure around these areas and either go to a big V-shaped reversal or, of course, structure and slowly recover or even go worse over time. There's a lot of different outcomes. That's always the way. But the general gist is that markets have probably found what we call a temporary base for now. Now, why is that? Well, a lot of it has to do with the bonds market. You'll hear a lot of people talking about bonds, and bonds tend to come up really every single time we see a sell, because what happens is the bonds market blinks and then everyone around the world, including central bank policy, says, oh, whoops, we better inject liquidity. And that's kind of what's happened over the last week. Obviously, we hit some big yields, US 10Y, well worth watching, US 20Y as well. And if you chart up US 30, which we will later on in today's video, you'll see there are clearly key levels that it looks like the US administration is looking at, and they do not want the market past that point. We even saw the Fed coming out last week and basically saying, we are watching minute by minute the bonds markets, etc., etc. Now, why is all of this important? Well, of course, it's all about liquidity. And as we saw here, we had one of the largest shifts ever in the US 10Y in terms of a weekly basis point shift due to the tariffs and concerns of escalation of a trade war or even just a full-on economic absolute war across the board. Now, why is this a problem? Well, of course, when you get spikes like this and you freak the bonds market out, everyone gets concerned. The bonds market is bigger in terms of market capitalization size than the stock market itself. But what we just saw was 4 consecutive days of outflows. And as you can see here from i3 Invest, these are previous kind of critical periods in time where we've seen that happen. And this is an interesting point because it tends to be around sell-off periods and it tends to be close to the low. Not always the lowest low, but certainly a sign of potentially overselling in the bonds market and therefore people freaking out. And as you can see here by the latest volatility in bonds and stocks, the bond market move index has actually continued to be quite high but stabilized, and stock volatility obviously is dropping off a cliff. Why this is generally stocks get optimistic way faster than bonds, and we tend to see bonds markets kind of, really look for policy shifts, for big changes before they calm down. And you'll get this a lot. You'll notice here when you get this huge spike back over during the Silicon Valley Bank crisis over here, the bonds market totally freaked out. So when we're looking at, freak out events, technically that's a bigger one. And of course, 2020 was absolutely wild. That was actually a lot higher than this. That thing went ballistic when you look at bonds under the surface. So there have been more crisis periods, I guess, like scarier periods, but still, it was about to have some serious issues. The bonds market blinked, everybody started to pay attention. When you have a look at foreign central banks, smart money versus dumb money, everyone loves these types of charts, but basically we just saw record outflows from the US stock market, and obviously retail investors, hey, looks like we're getting pretty aggressive because according to the latest data, it looks like everyone's leveraging up, 3 times leveraged NASDAQ triple Qs. Could that mean that the market wants to erode those a little bit? That is, push sideways to down? Yeah, certainly could be. So we have to pay attention now to how retail is flowing in. But I wouldn't be too terrified of this. A lot of people obviously are claiming US exceptionalism is over, etc., etc. You've got to remember that takes a very, very long time. And even if it was to happen, it doesn't happen just like this. So while money is flowing around the world, believe me, as we saw on the CTAs and other areas, we've already had a lot of money flying back into the US and probably will continue to do so, especially if news improves. It's amazing how fast people come back to things. Let's now take a look at gold spot. So when we're taking a look at gold spot, you guys know that we've been loving gold for 2 years. There are so many reasons. China buying it was just one of the reasons, but it continues to be one of the strongest ones. That is central bank purchases. And we actually saw here, according to Nautilus Research, a very interesting upward swing here where we had 95% without a 20% decline. And this is the first occurrence in over 1 year. So basically a very, very strong gold market. And you might say, well, that should mean that we're due for a pullback. And we've been talking about how it's overbought. Well, the latest data actually presents a pretty strong number when you're taking a look at the next 1 year and 6 month results. In fact, 90% of the time, 6 months later, gold is up, and it's up about quite a lot. You can see here, sometimes we're getting upwards of 19% gains. Now, if you've been watching the channel for a while, we had two main targets back in 2000 and kind of 23, 22. And those targets were $3,000 an ounce, which we have, of course, reached. And the other one was $3,600. Now, according to the latest information and the latest cycle theory that I'm looking at, 3,600 still looks pretty solid. Obviously, we're getting closer to that all the time. But could this be a peaking period for it? Well, it looks like there's a lot to do with the RMB and gold. And we'll look at that particular thing in an upcoming episode. So make sure to subscribe if you're interested in that, because, yeah, there's quite a lot going on with China, currency, and gold, and the way that it seems to be pegged together at this stage. Have we seen a moving of the London market to actually more to be in China in terms of gold anyway? Now, Good Friday this week, of course, is a shorter week, so we need to be aware of the stats surrounding that. Generally speaking, and of course, maybe we're not in general times, you can see what tends to happen into one of these particular events. Generally speaking, pretty much in the US, if you're looking at any shorter week, they do tend to be more bullish. And then the day after can sometimes be bearish. In fact, look at this. One day after, according to Stock Traders Almanac, we usually see red. So that would be, of course, the open the next week. Now, in terms of going into Good Friday, we basically have here 3 days of potential gains. And you can see here that overall, the week is generally about 1% positive. Now, this is going to be a news-driven week, so you can take the data as you wish, but still worthwhile paying attention to. Now, what about the S&P 500 after it did everything it's done? Of course, the huge sell into the massive rally that we had last Wednesday, into the big sell again, into the rally that finds us at the exact same point. Well, we'll look at dark pool liquidity in just a moment to see what Wall Street's been up to. But generally speaking, we can still make a new low, and statistically that tends to happen. Now, that doesn't mean it's an extreme new low. Sometimes it's just a stabilizing new low like over here before going up. Notice also that these tend to be flash sells. So that is that we get these flash panic sells, and when they're fast like this, they often do stabilize very soon afterwards. So this is a good rule of thumb that structure generally builds around these areas. And in general, you do have to expect that a low steal can happen. Now, here are the stats with what happens every single day post these events. And you'll notice here that 10 days after, the market is still a coin flip in terms of how it's stabilizing up and down. You can take this with a grain of salt if you wish, but I think what we have to expect is volatility to continue, and obviously for us needing to break through certain levels. Now, as we saw last week, we had the largest trade ever on the SPY, and that was massive. As soon as that came through, the next session, we dropped 50% of the gains. Then we saw massive trades, which you'll see in a minute. Then we've picked back up. What is going on at this exact area? Well, okay, let's have a look right now. So here is firstly the trade that happened on the Qs up at those peaks, sold off, bought back in, rallied back to this area. Clearly, there's a lot of activity going on here. Well, here are the updates to what we've seen recently. A 2 times long VIX futures ETF just made a big transaction, 10th biggest. Okay, does that mean that it's instantly going to spike up? Not necessarily, but still an interesting one here. UVIX getting a big trade on it. But the one that I want to focus on here were some of the other ETF funds. So this one here is the Wisdom Tree Quality Growth Fund. So that is big cap, big quality. Everyone kind of likes these. We saw a sweep coming in near the close, and obviously the highs here also got a transaction. Now, that is right where we would expect supply to be coming in. You'll see in our box later that we've created, which is basically just the resistance area of this current rally, that at this stage we are in kind of that neutral zone. Bears are going to want to sell some of these levels around here, and bulls are going to want to push through the zone and hopefully get through what we call the most traded area, which is pretty much actually around here. But you will notice some transactions have happened. Let's most likely take profits that are occurring around here. And then the next couple of days of trade, as we see earnings coming through, should therefore stabilize and hopefully create what we call structure in the smaller timeframes. Speaking of which, earnings season has kicked off so far. The earnings themselves, pretty good. The expected implied move of each stock, wild. TSM obviously needing to be watched this week, plus or minus 12%, Netflix as well. But the big thing here is the forward earnings. It looks like no one's even prepared to really put stuff to paper. They're saying, oh, we don't know what's going on. That's uncertainty. And when you get uncertainty, obviously you can get some problems in the market. Why? Because uncertainty can lead to firings. Firings can obviously lead to unemployment spiking, and unemployment spiking can lead into, of course, recessions pretty much. Now, unemployment spiking is generally a lagging indicator, but we do need to remember that in terms of what we saw recently, which is a technical bear market, that is a market that's gone from basically being positive to negative 20% overall, it's rare for us to not get a recession long term off that. And we do need to also remember there was a period here in the 60s, which is an interesting overlay. And we did see one followed 2 years later by, of course, some problems. So, sound familiar? Again, we went into a soft landing. Could we be going into a hard landing? Again, we'll poll you guys soon to see what's happening here, but that will be an interesting point. According to the latest Goldman Sachs risk off indicator, courtesy of Mike Zaccardi, you can see here that they've got risk off on a lot of their indications. A lot of this stuff, I always say it's kind of like after the fact. But anyway, here's the risk on, here's the risk off. You guys can have a look at it. I would say not too much edge on this particular chart here. That's going to help you too much to be an investor or trader, but still some cool stuff that they're following. And you can get a bit of an idea of some of the things that maybe some of the big guys do look at, which is, of course, equity flows, sentiment surveys, certain combos as well. Let's have a look at the expectation of now job cuts, that people will be firing moving forward. I think this is going to be expected by the street. And remember that the stock market is not the economy. So what tends to actually happen is stocks like these restructures because they know that jobs are pretty much the wages are the most expensive component, and they often rally off these events. So if we do actually see a bunch of job firings, oftentimes that can also help to push the markets up, although long term, that may not be a very good rule. Of course, for the overall economy long term, the Fed may have to step in. QE is, of course, being tabled at this point by many economists, including ourselves. We think that could be coming soon. S&P 500 breaks quarterly streak. That is, it went from being positive to negative over March, of course. When that happens, this next quarter, stabilization traditionally. After that, though, not so clear. Again, very important to look at some of these key levels moving forward. Now, on top of all of this, we also have a post that we put on over our X, links in the description down below, to do with buybacks. Now, buybacks have shrunk from over $1 trillion expected this year, and they're continuing to drop off during this earnings season. Traditionally, what happens, and this is why April is often a very bullish month for people, is that we get earnings. Earnings usually, kind of beat expectations on average, about 60, 70%. Then what happens is stocks start to get a little bit optimistic about the future. They go up, and straight after that, we exit the buyback window blackout. So basically, we see huge amounts of buybacks. We're not going to get those this year as much. So people are going to be, or at least these companies have already said, we're going to hold the cash and see what we need to do with it. So one of the big bullish catalysts for markets is not there at these key resistance levels. So we'll, of course, need to be watching that. Over the last 24 hours, it wasn't really clear what the market actually wanted to do. At one point, it was risk on during the open, semiconductors, tech doing quite nicely off the exemptions. Then, of course, we found out more information. What's happened then is we've gone defensive a little bit. Now, it's always a bit of a worry when you're at a resistance and defensives start coming through again. Yeah, we'll have to watch the structure quite a lot here because that could be signaling that around this next 100 points on the S&P, we could be in for a little bit of trouble. When we look at the last 5 days, you can see here the movements have been clearly a bit of risk on. Semiconductors, tech up there near the highs, and financials also doing well off the current earnings. Jamie Dimon possibly getting a little bit of gains off those good financial recoveries. Now let's have a look here at the SPX. So basically it's hit a couple of key zones. First up, the daily 20 moving average. That's the red line here, guys. It has respected that the entire way down. Now, during our live stream that we do on Mondays, and obviously we have them for our private community as well, fxevolution.com if you're interested in coming and joining us there. We were talking about the one on Monday, and we were talking about two key zones. Obviously, the gap fill, 5,600, and also the weekly 20. Now, we love the 20. The 20 is definitely one of the best indicators. It's basically what we call mean reversion. And you can kind of see that it's interesting that the gap fill would be sitting on a similar level. So between 56 and 5670 is a very key zone for the S&P. Let's now have a look, though, at overall the US 500 in terms of the most traded level. So what we also know is that we saw huge dark pools, huge liquidity entering over here. We got a rally. We got, of course, Liberation Day. Liberation Day dumped off. We left a gap, which is, I'm using the close gap. So some of you will use the bottom end, and obviously you'll say, well, it's almost hit that one. And then basically what we're looking for is what will the market do if it comes into this area? So we've already had a couple of large dark pools. It could suggest that there are sellers already involved in this market trying to push it back down. What we know is we've got a big range in terms of structure overall. And for bulls to really be in control, they're going to need to push a 5,800 plus. So we're still in the danger zone. We are at a big push up, which is historically not necessarily the greatest thing for markets to say, wow, everything's over. Vol is still high because the VIX is above 30. And of course, the options high and low levels, I've activated those so you guys can see it. Let's now have a look at the options market itself in terms of the 0 DTEs. So what you guys will notice is that 54.75, for whatever reason, is being struck really hard. And this seems to be pretty consistent. 54.50 on the next session plus 54.75 on the 16th struck really hard. So there's a change in negative gamma to positive gamma around that point. So there's clearly some big resistance on the S&P at around those areas. And over the next 24 hours, even 5,400 is going to be hard for the market to get through. Now, on the bottom level, you can see here by Thursday this week, we're going to be basically looking at a big 5,400 put level. So if we get underneath 5,400, we stick there, then we're going to probably see more of that waterfalling effect where markets could push towards 52, which is the next zone, or even 5,000 or even 4,700. You cannot discount these zones. So we're coming up to a good, important structure. This is the type of area where we often say, patience, react, don't predict. It's better to actually let the market structure up. And then, of course, you can recognize potentially replicatable trades, investments, positions, whatever else you want in those. We've seen that twice. Last week, we got Monday and Wednesday being exceptionally replicable trades on the lows. They were structure-based. They were created with a mixture of dark pools, a mixture of options, a mixture of knowledge of structure and TA, a mixture of knowledge of course, statistics. And you'll actually find that during these times, you do tend to get these opportunities. It's not necessarily hard to trade. The difference is it's hard not to take trades. And sometimes they are the best. Let me know if you agree with that in the comments. Sometimes people just need to be warned that sometimes the best trade is no trade at all if you don't have replicable edge. Nvidia 115 remains this important most traded level. You can see 120, 115, nothing new there on Nvidia. And Tesla, you notice here that we're sitting at this 265 constantly, and it's sitting at 250. So 220, 200 base, 250 seems to be some weird equilibrium for Tesla, 280, 300 on the top. So they're the resistance levels that we're using. And I would say that at the moment, it's probably most important for us to focus on the options with Tesla. As you can see with the price range, we've clearly got a support and a resistance that we'll look at soon. Now, when we look at one of the bonds indicators I use, it didn't really have a great session. Let's have a look here. We kicked off this week down. So even though the market was kind of flat up, it was defensive in nature. So that means that basically someone was defending and buying a bit of buying potentially more of the kind of defensive stocks. They weren't buying growth and feeling good about that. They were maybe taking profit there. We saw also effectively the bonds market not really saying, wow, I love life at the moment. And it's still trying to stabilize. So yes, we've seen outflows at epic portions. Yes, this tends to be a structural stabilization zone. Yes, we've seen pickups in stocks, as you can see here, percentage of stocks above the 20-day moving average when it came off its lows, which is traditionally a very good dip buy zone. And that's all good, but the problem still remains with yields. If yields continue to remain erratic and move a lot, and obviously if we see the 30Y, the 20Y go through some of these key levels, you're going to need to have that 5% on the 30Y. Clearly, there's some kind of 4.5%. I think that we need to really consider that in Trump 2.0, they don't care about stock market as much as they care about bonds market. Bonds market is the most important market to be watching over the rest of this year. And of course, we'll have to look for the TA trigger points. That's going to be, for the most simplistic terms, the areas to be watching. 4.5 on the 10Y and a 5 on the 30Y. And I would be watching those. I think those are imperative, basically alert levels for you guys to be watching. And yeah, it's going to be important. What about the US dollar? It's probably oversold itself down to these levels, but you can see here it's been absolutely getting mauled. Big volumes the last couple of sessions as people dry up on US dollars and move around the world and stuff. This will be an important structural zone. At the moment, as I broke it down onto the smaller time frames, not really seeing too much replication of structural buy yet. So we will continue to watch for this. Some key levels probably going to be around this 140 where we had those last bulls. Other than that, the trend is still down for now. However, it does seem significantly oversold, but that doesn't mean that you just go dump, go buy it or something like that, because it's not enough to go off. It's the same thing with gold. We know gold's overbought. You guys know I'm bullish on gold. There's no doubt I am. 3,600 is our aim, but at the same time, you don't want to probably do investing in at these prices. It just doesn't really make as much sense as it once did. The risk reward is not as good. And although we know China's buying it, central banks are buying it, although we know gold has been very, very good, if we do go into a liquidity crisis, let's say we hit 4.5 on the 10Y or the 30Y goes past 5, and then all of a sudden the liquidity crisis goes through, gold is not safe in a liquidity crisis. If you want to go and have a look yourself, go check out 2020 and see what happened. It gets mauled, guys. And at the same time, it skips price. So you might think, I could get out. I was seeing gold during 2020, and obviously that was an extreme case. We were seeing gold move $40 an ounce with barely a tick. So basically there was no liquidity. It dried up completely. So just remember that gold, while great right now, and it's been a fantastic run, and we hope it keeps continuing. I mean, the trend is still up. You just got to keep that in the back of your mind in terms of risk. Now let's have a look at silver here. You can see that silver has bounced. It has found, of course, the downward or this little trend line that we had through here. I'll show you guys this. So obviously this was the trend line. It busted that trend line, came back and it's testing it. Still looks pretty good. I do like silver, of course, in terms of where we're at. And basically, as we saw, there was a repeatable structure down in here, which was about in this area. And that so far has yielded an okay return if you knew what you were doing. Now, could this make a new all-time high or a new high? Not all-time, because 70s and 2011 were pretty crazy. Certainly could, and it does have still a bit of runway on it. Now let's move over to oil. A lot of you guys getting excited by oil. Huge drops followed by big rallies. It's above $60. We do have the inverse head and shoulders. We do have the technical break at 64. We do have a proof to 72. Oil is very political. It's a very tough trade out there. I would be cautious, but at the same time, that's the technicals for it. You can't deny that that's the technical setup. Weekly close also was very wick-like, which tends to hold excitement. And I always say that this is usually a stabilizing level. So generally speaking, you'd be looking for that. Tesla's in the middle of nowhere land. You can see this based on that doji price of the previous kind of sessions. And it's in the middle of kind of the 220 to 280, 300 kind of bracket. So obviously at the moment, that's where it sits. And Nvidia's at the most traded zone. We're seeing a lot of the market kind of sitting at these resistancy areas. Semiconductors is similar, previous support becoming potentially resistance. Very important charts to watch. Daily 20 as well. Look at this resistance. Want to break that. Come back into the most traded areas. Back up here at 221, and then we'll see who obviously is the victorious person. Is it going to be the bulls or the bears? You can see here as well crossing of the 20 and the 50, well known as one of the more popular crosses to show that downward trends are in. That being said, I see these fail all the time, so you don't want to necessarily pay too much attention to that, but it will act as dynamic resistance. So there's a lot sitting just above price. We're getting into that danger zone of, is it worth, not being sharp and fast in those areas? Obviously, China, absolute liquidity injections, continuing to liquidity inject as we see all of this tariff discussion go through. There's no doubt that the longer tariffs sit, that it's going to be a problem for China, as it is a problem for pretty much the rest of the world, now all of the world in general. But at the same time, we'll see what happens here. So at this stage, it was a coordinated most trade zone throughout this, the DAX, and many other pairs. And so far, we've bounced. I would say the best thing to watch right now is just the S&P and the NASDAQ. Those two make the most amount of sense. Let's have a look at the NASDAQ. We did do some pricing on this during our live stream. We spoke about the key levels here. So, of course, the big thing is going to be around this 19,600 zone. That's going to be gap filling from the Liberation Day announcement. It's going to, of course, be in the most traded zone, and we're pretty close to that. So Again, my suspicion is that we could do this. However, again, suspicion is obviously a prediction in itself. So that's not really replicable. You must find structure. And when we're looking at structure, all we really got through the last session, if you go down to smaller time frames, because I am enjoying the NASDAQ at the moment, is that we came back into this demand, we filled the gap, we rallied off it. We've kind of shown a bit of weakness here in small time frame structure. There are going to be shorters here. The shorters are going to try to push down off that. Obviously, that's the structure of the short if you're going to take a short. But at the same time, you push through this, we could easily go 19.6 level, and then we'll find whether we get more structure in there. At the moment, I'd say the small time frame might be owned a little bit by the bear. But yeah, volatile period. Is that really worth it? Let's move over now to the US 2000. You guys can see here that we've clearly got a rally that's come in through. It's been weaker as a lot of this debt crisis stuff and other things have been going on in the bonds. Have people worried about companies inside of the US 2000? There tends to be a lot of businesses that are refinancing this year. The 61.8 fib was hit. It rallied back up. And at this stage, it's not looking like it's going to get there, but 2000 would be the key resistance to be watching. It is weaker than the NASDAQ, which is expected. And at this stage, if we're going to get a proper rally, we need to see risk on across the board, generally led by semis, generally led by technology. That is usually the area that you need to see break out. Then, of course, the US 2K will come after that if things start to improve. Bitcoin is kind of similar. If you're looking at crypto right now, it really is the one to watch. We've currently got this double bottom in play that pushes towards the resistance. Funnily enough, this double bottom resistance correlates very well with the S&P, around 5,600. So if you think about it, they're kind of all linking together to that level. And we've got semis as well that would be the most traded zone. There's a lot liking at that area. If I had to guess, that would be a zone I'd be looking at. But yeah, we'll see. Again, the key here is really going to be find replication, find repeatable steps, understand what we're in. And as a VIX above 30 always states, it is highly volatile. And remember, just like that, things can escalate or de-escalate very quickly. Earnings season so far, though, has kicked off well. So we'll see how Bitcoin goes. 89,000 is going to change, or 88.5 area is going to change, I think, a lot of people's opinions, because we'll go from making a series of lower lows and lower highs to a higher high and breaching through what has been a downward market pretty much all of 2025. In terms of news moving forward, just remember, guys, we've got Friday as a Good Friday. And if you're looking at the markets themselves, there's a lot of weird emergency meetings that are coming out. So that'll be important. Core retail sales, Wednesday, 8:30 is going to be one that people will look at. Fed Chair Powell is coming at 1:30 p.m. That may be an interesting one. Last time was a nothing burger. Maybe it is again, but we never know. He might say he's going to support support the bonds, or who knows. ECB press conference on Thursday as well. So just remember, there are plenty of bank holidays coming through. You guys need to be aware that we do have a shorter week. They do tend to be more bullish than bearish. Again, that's just the stats. We'll have to find out what ends up happening. If you enjoyed today's video, remember to subscribe, smash that bell icon. Thank you so much for watching. Follow us over on X. Follow me on LinkedIn as well if you're interested in some psychology stuff I wrote there at the start of the year. I think it's really, really important for current times. And obviously, if you're interested in our courses and stuff, you can check out fxevolution.com. Thank you so much for watching, guys. Thank you for giving me a thumbs up if you enjoyed the video. And it is going to be, still a very interesting time. I think we're at what we would call more of a neutral bearish zone. But what do you guys think in the comments down below? Let's find out what happens next, and we'll be there with you.